bought it for $100. They marked it up 43. They ended up with a 30% margin. But people look at the dollar and say, well, yeah, I made the $143 I needed. Well, let's reset the whole calculation. Cost price will still be $100. So the actual margin percent is now 43. To get a 43% margin, the markup actually has to be $75. All right, today we're going to talk about markups and margins. Number one, why everything you do on a markup is a massive mistake and is probably costing you thousands and thousands of dollars and probably all your profitability, and why you need to focus on margins instead. If you don't know the difference between the two of those, we're going to cover that today, and how a simple decision to adjust your thinking around markups and margins can have a massive impact on how profitable you become and how long you stay in the market.
I'm Dennis.
And I'm Greg.
And this is the More Profit, Less Stress podcast,
where we provide the tools for more profit and less stress in your business now so you can turn into a valuable asset later.
Well, I think one of the biggest problems that people make when they're setting up their pricing or even just trying to establish how to make more money is they're too busy focused on the markup side of things because everyone tells them to. Oh, you got to add like 30% to your materials, 22% to your labor, 50% to your labor. Oh, just double your price. Whatever you pay, just double it. So you add 100% to whatever it is that you're selling and you'll be fine. And then just focus on the revenue and go sell a whole lot more. But no one ever actually breaks down or talks about how the money's actually made in the margins, not in the markups.
Yeah, 100%. And actually, because we've done a lot of research on this, you and I, that basically somewhere between 80 and 90% of businesses either go bankrupt or close. And there are varying reasons, but for sure this subject is number one. There's no question. Like messing up their pricing is number one. And we always go back and try and tell people if you know, this is your revenue. So in business, and sorry, just to back up in this whole subject, any business, you buy something and you sell it to your customer. So
even if it's your own time,
yeah,
still
exactly.
Buying even your own time.
Exactly. So you're buying materials or you're buying labor. So let's say a material example, quick. You buy a material for $10,
sure,
and you sell it to your customer for, just as an example, $20. So the difference between the $20 you sell it for and the $10 you pay for it, we use the word gross margin. Some people say gross profit, but that difference is the margin, right? And it's not markup. So we'll get to that in a sec, like you brought up. Knowing that number, knowing the number you need is everything in business. Because if you want to make, say, 10 or 15% profit, then your operating expenses can only be 35 to 40%. Like if you're buying that thing for $10, you sell it for 20, you got $10 left. That's your gross margin. If you want to make 15%, then you want to make I guess $3, right?
Yeah, I don't think even most people even know how to look at it that way. Like if most people get back their profit and loss, really the only thing they understand is that top number.
Revenue.
And there's a whole lot of yada, 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 yada in the middle. And then they try to figure out if that bottom number is actually profitable or not. And if it's not, their answer is, well, I should go sell more.
Yeah.
Where some more astute people might actually look at it and go, well, if I run through my math on my P&L and I consider revenue to be 100% of everything I make, well, if I divide my revenue by my expenses, that should be what I have to mark everything up by to make more money. Or my neighbor told me to do 30%, or my accountant told me to do 15%. Right. But then they flip that number to add to it and say, okay, well, I know I need 30% to cover my expenses, so everything that lands, I'll mark up by at least 30%. But the first problem with that equation is they actually haven't stopped to go, but how much net profit do I want on the transaction? I think the other challenge is, and you and I have discussed this a lot in the past, where people get the whole calculation wrong is, when you do the math from the top down, you're actually calculating margin.
Yeah.
And most people don't think there's a difference. So on a bigger number to a smaller number, that percentage difference is always your margin. The problem is when you add that smaller number to try to go up, so let's say it's 30% on $1, well, you're getting $1.30, but at top down, you're only getting like $1, you're only getting like 22 cents or 22% difference.
Yeah. That is the number one mistake. I actually know of an example where a company was like a chain of stores. The buyer, so buying position, buys a product, determines the pricing. Their budget was to make a 43 margin, but they went and bought grab your phone. They went and bought a whole bunch of products and shipped them to all the stores and took a 43% mark up. So just as an example, 43% markup is what margin?
Well, if we put in a cost price of, say, just a random $100,
Yeah.
and we'll throw in a markup of 45%.
43, go 43.
43%? A markup of 43% translates into a 30% margin.
Yeah, so there's a perfect example. So this person confused markup and margin, we're talking like, hundreds of thousands of dollars worth of product, priced it at a 43% markup.
Right, which gave them $143.
Correct. And ended up with a 30% margin?
30% margin.
Yeah, so let's pretend that company's operating expenses were 30%. It meant on those hundreds of thousands of dollars, they made zero profit. It's crazy.
I'm trying to figure out why they're not making more money.
Yeah, exactly. And for anybody watching this, it might be assumed that if you're a small business, that's an error you might make, but it's an error lots of people make. I mean, this was we're talking almost a 100-store chain. And the buyer for that still made that same mistake. And
I've worked with clients who've had their masters in business and still didn't quite understand markups and margins. But to finish this conversation, they bought it for $100. They marked it up 43. They ended up with a 30% margin. But people look at the dollar and say, well, yeah, I made the $143 I needed. Well, let's reset the whole calculation. Cost price will still be $100. So the actual margin percent is now 43. To get a 43% margin, the markup actually has to be $75 or 75%. So the old sale price was 143. The actual sale price they needed was 175. Yeah. So there's a $32 difference in everything that they're selling based upon just having that calculation wrong. And I think the other problem with this whole conversation is that even if you're the same business in two different areas, or you're the same trade, or your buddy's a plumber and you're a plumber, or you own a retail store, your buddy owns a retail store, your margins you're going to have to hit are probably different than theirs. I've got 4 or 5 businesses all in the same industry, and every single one of them, the margins they have to hit to make money are different than each other.
Yeah.
Sometimes by as high as 10%.
Yeah. It's interesting. You saying that's making me think back to, we had a renovation company as a client, and a lot of people in the renovation or trades industry think, okay, when I buy this material. So actually, before we continue with that, back to our initial discussion, we were talking materials, but you brought up labor applies as well, because it'll apply to this renovation example. Labor's the same, right?
Yep,
like we know that. So,
same.
and it could be if you're in the trades business, it could be if you're in a law firm, a doctor's office, any business where you're buying an hour from. Basically, you got people working for you, you're buying an hour from, and you're selling it to your customer. Which, to make that simple to understand for people, because you're like, well, it doesn't really apply to me. Just think if you had a business and you had subcontractors.
Right.
So you would take the invoice from the subcontractor and you would do some kind of margin on it, or markup if you knew how to calculate it, and sell it to your customer. That's the same as if you have an employee and you pay him for an hour to go do that electrical wiring or dig that ditch, or if you're a dentist or a doctor or a lawyer or whatever, you spend 2 hours on that client, you pay that employee for 2 hours and you sell those 2 hours to your customer. And you got to sell them for more than you pay the employee, obviously, which is no different than a subcontractor. So knowing that, going back to the example of the client we had in the renovation business, they knew this. They knew how to price like this. And just to drive this point home, if you get sucked into the, hey, I got to buy, if you're in the, say, trades business, and I got to buy this plywood or wire or whatever and mark it up 10%, do a quick, what's a 10% markup? I feel like it's like a 9% gross margin.
It's 9%. Yeah. So like you guys can do that. You guys can just think of it this way. Grab a pencil, hold it up and look at it and say to yourself, I bought this for $1.
Yeah.
Now I'm going to take this thing, I'm going to mark it up 10%, I'm going to go sell it to the market. Well, a quick markup on a pencil at 10% is $1.10.
Yeah.
So now you go to present this particular pencil sale to your spouse, your kids, your significant other, or your customer, and they scream and they yell at you and they chew you out, telling you that $1.10 is way too much. So you panic and you take 10% off the price. The question I always ask people is,
less than $1.
did you make money, lose money, or break even? And people go into a story like, well, I had to bring it to the market and I had to do all this, and I drive them right back to the math and just do the math. If I take 10% off $1.10, did I make money, lose money, or break even? Well, 10% off $1.10 is 11 cents.
Yeah.
So I lost money on that pencil through a panic of pricing, not realizing that a markup isn't a margin.
Yeah, totally.
So a 10% markup works out to exactly a 9% margin, but the higher you mark up, the bigger the difference between markups and margin scale.
It was that renovation company was an interesting story because they were priced great, everything was working well, they knew how to price themselves, and they wanted to make 10% of their jobs, which meant their margin had to be the 10% profit they wanted to make plus whatever operating expenses they had. And I believe in that case, it was 15% operating expenses. So their margin had to be 25 to make money. Well, another renovation company came into the market and started just like marking up 20%. So they were undercutting them in different jobs they were competing in. And our client was like, well, what do I do? I'm getting undercut. I'm like, well, you got two choices. You can match that price, but now you're going to lose money on every single job.
Yeah, if they matched that price, they would have gone from a 25 margin to a 16 margin.
Yeah. So you can do that, but you're going to start running out of money. Like if you end up losing money on jobs or products, the pencil, whatever it is, you're going to lose money on every job. You've got to, and the reason lose money is because you got to pay your operating expenses every month. So if you're losing money on every job, where's that money coming from? You got to draw back from previous profits, or you got to start borrowing money, or you got to start going into a line of credit or an operating line, or
you start delaying your payables to try to free up some more cash.
Exactly.
And you're grabbing deposits from the next job to pay off the bills from the previous job.
Exactly. So they stayed to their guns of we're going to stick to our pricing, and I said, your competition, like. We knew with that business, so this is something for everybody to think about. We knew with that business, our client, their operating expenses were very lean. So they weren't wasting money on stuff they didn't need to waste it on. So because they had lean operating expenses, we knew their prices were pretty much as low as you could get to make a profit. So if the competition's cutting that under, we knew the competition wasn't making money because we could do the math. And the choices were match and also lose money, and then who can last longer before one goes bankrupt, which there are companies that do that strategy, by the way. Like if they have deep pockets, they'll drop the prices to get their competition to lose money too, and then hope they run out of money first and then bring the prices back up. But that's hard to do with your customers. Drop your prices for a while, then bring them back up. So second choice was keep the prices the same and let the competitor run out of money and go bankrupt. So our advice was, well, go look at your competitor, do some research, and see if you think they have deep pockets, meaning a lot of money to borrow. And their analysis on that was they didn't have those deep pockets. So they said, let's stick with our guns. They stuck with their guns, did the pricing.
Which was short-term pain.
Yeah, short-term pain, but got the jobs where the other company wasn't competing. So they just went after jobs they weren't competing. The other company kept getting jobs where they were losing money. And it took about 6 months, and finally, it was at a workshop we did. Finally, that client stood up and said, wow, just had a great win. They said that, because they went through that stress of do we match? And she stood up and said, we did it. Like that company just went bankrupt last week. She's like, they're done. So now we got no concerns anymore. So it's just proof in the pudding that if people don't understand what they're doing, they'll run out of money, they'll go bankrupt. And back to your point of margin markup, it's such a common mistake. Like just, it's a simple way to explain it. If you go buy product and you mark it up 10% or 15% all the time, and just say 10, you mark it up 10% all the time, and you said that was a 9 margin. Well, if you want to make 10% profit, you have nothing left for your expenses.
No.
How do you pay your rent and your staff and your bookkeeping bill and your marketing? And like people don't realize you got to pay those expenses.
Well, and people think money's just money.
Right.
Like there's all kinds of books written out there about how to do business and how you should take 4 or 5% of every transaction aside and put it into a bank account because that's your profit for the future. But I'm like, that's a fantastic idea, but you don't know how much you have to make already. It's not just robbing Peter to pay Paul. And I think most people don't realize all the symptoms of bad margins. Like if you're chasing deposits to go pay off last month's bills, you have a margin problem.
Yeah.
If you find that your work quality is having to drop because you're having to hire cheaper and cheaper people to do the work, I guarantee you have a margin problem. If you run to the bank to try to go cover overhead expenses and you've been in business for more than 3 or 4 years, I guarantee you have a margin problem.
It's a really good, we should expand on that because especially trades businesses, if you're a trades provider, so a sub-trade or a trade, and your client is like a builder or a developer, somebody big.
Who you feel beholden to.
Yeah, exactly, right? So let's say you and I are both trades companies, right? Like subcontractors, and there's a developer, and we both go in trying to get that job. And then it becomes a race to the bottom. You gotta bid low to get the job, right? And they want that to happen. Mm-hmm. So they do that. And then I think in both Canada and the US, there's I know there is. There's a time window where as a trades company, exactly. Yeah. So if you haven't been paid, you can put a lien on the property. So to expand on your point earlier about robbing from Peter to pay Paul kind of thing, or robbing from the future job to pay the last job, like for those trades companies out there, this is an actual strategy by developers and builders, and you got to watch for it. So we go bid on that job, and let's say you outbid me, or let's say you. Yeah, let's say you undercut me, and you get the job, and then the builder or developer says, well, we can't pay you for 90 days. Like when the work's done, we'll pay you 90 days later, and you want the job so bad, you're like, well, okay, let me drop my pants and I'm in. And then,
by the way, when you do that, you have to cover the materials.
Right.
You have to cover the labor. Your overhead still has to be paid.
Your
the
rent,
bank's not going to back off and say,
no.
yeah, don't pay my loan payment.
Right. Exactly. So you go do that. You still got to pay your expenses. You still got to pay your materials.
And let's say the job took 90 days. Well, so now you've got 90 days of overhead into it before you even submit your invoice.
Correct. And then you get paid for 90 days after that.
So you got 180 days.
And they will tell you, yeah, we'll pay you, but you've now missed that. Let's say that lien opportunity is like 45 days now.
45 days from what I remember.
So your job's done. You got 45 days before you can put a lien on it because you haven't been paid. But the deal was they pay you in 90, so you just missed your 45-day window. And then, like, we had a client this happened to. It was like this actually happened. They got 2 different developers, each with give or take $350,000 worth of work. So the total was $660,000 worth of work. And the same story we just said. He underbid. They said, hey, so he underbid against our advice. They said, hey, we can pay in 90 days, again, against our advice. So he took it because it's $660,000 worth of work. It's
a lot of money.
Yeah, it's great. And, this company started small, built up, added a bunch of crews, and got to a bunch of crews doing millions of dollars in revenue, took on these 2 jobs. They dragged them, and then they didn't pay him. He had to pay all those cost of goods and expenses, like he just said, and he didn't make much money on the job to begin with, missed his window to put a lien. And then they just kept saying, oh, well, the person that's going to cut the check is away or on holidays. Oh, we missed this pay run.
We hit the deadline.
Yeah, so we'll get you on the next one. And then what happens is you get so desperate, you're like, well, if you can cut me money now, I'll give you like a 20% discount. And they're like, oh, well, I can get you the check today. In fact, I'll courier it over.
Right.
So then they go get paid, but it's too late and they lost money. In this guy's case, they dragged so long, he actually lost his company.
Yeah. It doesn't take much.
So you could lose your company, or you could take such a discount that you actually lose money in the whole deal. And if you keep doing that, you're on the road to bankruptcy. Well, and it's just out of desperation.
And it's that danger of always looking at the revenue dollar.
Yeah.
Like my favorite's always been when people deal with vendors, and the vendor's like, yeah, you can buy our product and you can mark it up 100%. You will make 100% on every product you sell.
Right.
Which sounds great in theory from a markup, but when you understand it's only a 50 margin and you've evaluated your overhead, are you sure 100% is enough?
Yeah. Yeah, because in some cases, companies' expenses are more than 50% of their revenue. Which, by the way, if you're watching this and your expenses are more than, say, 40% of your revenue, there's probably a red flag your expenses are too high. There are the odd, like I think we have maybe the odd client where expenses can be that high, but it's super rare.
Well, it also depends on what other things that have happened in the market and other things too. But the best way to handle that is to get somebody who can actually walk through your income statement with you show you what you're missing, see where you're blind, and actually fill in those gaps before you end up in a situation where you're in a dumpster fire you don't know how to put out.
Totally. And this actually loops back to a different podcast we did on borrowing money at high interest rates, because now those companies get in this situation. They're like, holy crap, I can't pay my bills. They go borrow money. Bank won't lend it to them at a good interest rate. So then they go borrow money from like those third party high interest 25%, or they go use their credit card. And they got high percent interest. So not only did you lose money in the job, but now you got crazy high interest on the money you're borrowing. So now you've doubled your loss.
Right.
It's it's a slippery slope. And it definitely always comes back to understand what margin you need, but don't get seduced into the margin markup.
No, actually, I tell all my clients that you're forbidden from ever using the word markup ever again.
Yeah, agreed.
If you understand how margins work, you'll notice that the biggest mistake you'll ever make is talking in markup, because you obviously don't know what you're talking about when you're in the markup situation.
Like literally, I think it's good advice. I think if you can't stand up in front of a crowd and teach the difference, like if you can't teach it, remove the word from your vocabulary. Just don't use it. Don't use the calculation. Yeah, I agree. Totally.
Well, and it's also fascinating to me, like how many experts don't understand the difference. I was at a networking event, and I got up and I asked the group, who here knows the difference between a markup and a margin? And there was a gentleman there who was heavy into business development, right? And I looked right at him and I said, well, based upon what you do, you obviously know the definition. He sat back, crossed his arms, and said, of course I do. I just want to hear what your perspective is.
Right.
Right? But most people never get it. So if you don't understand markups and margins, do some Googling, watch some YouTube videos, figure it out. There's a ton of markup and margin calculators that are out there that can show you where you're pricing wrong. But keep in mind, none of that matters if you don't know your ratios to be able to cover what you need for margins, not what the other guy needs for margins.
Yeah, 100%.
Thanks for listening to the More Profit, Less Stress podcast. If you liked what you heard, be sure to subscribe or follow on your favorite podcast platform and leave a comment or review if you're feeling generous. To learn more about us and what we do, check out our website. Until next time, take care.